My name is Grace Lee, Aqua Board Director, and I will be your moderator for this webinar. Now, let me briefly introduce you the two speakers today. The first one is Jiro Tsunoda, Senior Advisor, CRD Association Japan, who is a former Principal Portfolio Management Specialist at the Asian Development Bank. And the second one is Dr. Lan Nguyen, Deputy Director, International Department of CRD Association Japan, who is a former Research Associate at the Asian Development Bank Institute. We have another two guests, Director Megumi Sagara and Senior Analyst, Dr. Khaliun, Dovchinsuren, both from International Department of CRD Association Japan. They will join today's Q&A session. The first presentation will provide us with a variety of approaches for building up a credit risk scoring model for generating borrowers' probability of default information. It will also cover the framework of CRD, which stands for Credit Risk Database System in Japan, namely the features of the financial statements and the default information database, was exploring a nature of the traditional CRD scoring model. The second presentation will explain the benefits of machine learning and the several practical applications of a machine learning scoring model in banks, including lending program diversification, larger target audience for loan, and improve the risk monitoring. He will also introduce some of the assessment methods to help banks evaluate the credit scoring model's performance and interpret the results of the machine learning scoring model. I should now hand it over to Mr. Jiro Tsunoda to kick off today's webinar.
Colleagues and friends, CRD Association is established year 2001 as a non-profit organization and membership organizations. Its mandate is to provide the MSME financing facilitation. At the time of the year 2000, there was a collapse of the bubble economy in Japan. At that time, the lending to the MSME has drastically shrunk. And because of the government agencies, Ministry of Finance, Ministry of Trade and Industries, and Bank of Japan, they took the policy measures to facilitate MSME financing. Our organization was established at that time for promoting the MSME financing. CRD is a membership organization comprised of the members of the banks and the Credit Guarantee Corporation. They will give the MSME the financing or the credit guarantee, and MSME submit those member financial institutions, the financial statements. Our organization, CRD Japan, is using this financial statement data for creating the database as well as the scoring model. The data to be collected by the members are comprised of the financial statements, default information, and non-financial informations on anonymized basis. CRD is established the credit scoring model and return back to the information of the scoring, also the probability of default and other services to the CRD members. Presently, we have 166 numbers of the members comprising of the Credit Guarantee Corporations 51, banks and financial institutions 95, and credit rating agencies and other companies 16. Government agencies, 4 government agencies also uses the scoring database for their research purposes. We have now numbers of the financial statement of the SME, more than 26 million, and also the sole proprietorship of the SMEs, more than 6.6 million. So we have in total more than 30 million financial statements are kept in our database, which is linked to the default information. So we are the largest data, we could say, center of the financial statement in Japan. Now we just shift to the topic of the scoring model. Today we discuss about the scoring model, but let me just put some elements of the scoring model. Elements of the first elements would be who are the target borrowers, whose credit risk to be assessed, and what are the data to be used, or what are the available data, and the analytical methodology, which will defining the model structure. And who owns the scoring model? I just listed up credit card companies, banks, and financial institutions, credit bureaus, or sometimes credit registry, or credit rating agencies, and credit risk database, that is ourselves. And what risk information to be provided is the probability of default. This is a historical overview. Let me skip next two slides, but one of the important thing, or if I can recall, is Fair Isaac Corporation started their operation in 1965. So this is a very, we could say, critical momentum coming up to with the scoring model of the consumer credit risk. After that, all of the scoring model development based on this the scoring provided by the Fair Isaac. Let me move to this slide. This is the slide of the category of the, they try to categorize the methodology of the scoring model. The methodology, I just, 4 categories of the methodology I put here. The first one is the non-statistical export judgment, and the statistical model subcategorized with the 3 approaches: logistics, regression, linear discrimination, and hazard analysis. And third category is stochastic model. That would another way of saying the option approach. And the last one is machine learning or AI scoring model. The methodology which I'm going to cover today is the first and second one. That is the non-statistical export judgment and the statistical model logistic regression. Actually, 2 of them are currently prevailing and commonly used for the owners of the credit scoring model. And the stochastic model is actually being used by the credit rating agencies based on the data of the market, stock market, as well as the corporate bond price data. There are 2 approaches for them: structure model and induction model. Let me say about the export judgment model. That is using the indexes for structuring a score table. However, these indexes is just based on or dependence on the expert judgment. There will be no good rationale for the selection of the indexes in a statistical manner. How about the statistical model, logistics regression? It would be the correlation between variety of explanatory variables and the probability of 2 objective variables. That means that 2 objective variable is a default or non-default. So explanatory variable will be decided actually by the data which to be collected and used for this model. So what kinds of data, what amount of the data to be used? That is a key issue, and it will define the nature of the scoring model. On the right side, there's a description of the white box and black box is there. It is a reference when we discuss about methodology. White box, the model logic is open and interpreted and applicable for structural data. However, the black box is a model logic is not open and not totally interpreted and applicable for structural data as well as a non-structural data. So non-structured data is something like voice or email record or the pictures or that kind of thing. And this AI scoring model or machine learning, this is to be discussed by the Dr. Lan next presentation. When we talk, then we talk about the data, what kind of data to be used for establishing or creating the scoring model. I listed up here 1, 2, 3, 4, 6 kinds of data. One of the important data to be used for the scoring model is the historical payment or historical payment performance. The data itself is to be provided internally, in-house data by the banks or credit guarantee corporation or any financial institutions. They could keep this historical payment data as well. It is to be provided by the credit registry. Credit registry is the very important role in this field. That is usually the public entity supported by the government or the central bank, and a very big presence in many European or Asian and Latin American countries. So, and this data is overall used for any targeted customers. But one of the things I just want to point out, credit bureaus may have their access to the credit registry is conditional. So not all credit bureaus can access to the credit registry. So banks can share the data among the credit registry, but credit bureau has a conditional access to this credit registry. Next data is a financial statement. Financial statement data is for the listed companies, large corporations or medium-sized corporations. That is the public information. However, MSME or the sole proprietorship companies, those data is not open or only available at the banks or the financial institutions who are extending the credit. So, and also the consumers is not preparing the financial statement. So again, credit bureaus may have the difficulties in accessing the financial statement data. So they may have from the public sources in the case they want to keep that one. And qualitative or categorical data, it is important data for assessing the risk for the MSMEs and sole proprietorship and consumers as well. But again, this is not publicly available, so banks and financial institutions may need to have those data through the interviews with the borrowers. And macro business environment data, it is basically, we could say, available from the public sources. Information provider will provide those data. And the security market data, actually, this is for the large corporations and medium-sized corporations, credit assessment. It is to be used for that purpose. And the rating agencies or anybody can get from the information provider, such as Bloomberg, Thomson Reuters, and so on. One of the things pointing out again is that the credit risk database, CRD, is using financial statement data, and also that some part of the qualitative or categorical data, just limited items for data sorting. CRD will not use the historical payment performance or even the macro business environment data. Another things I just want to point out here is credit bureaus. Credit bureau is a private entity, but is a big presence in US, UK, and Japan. They are another, we could say, the big data center in this field, credit risk information. I just next is we just try to compare the, we could say, the types of the credit risk scoring model, which is used, which is using the expert judging methodology, expert judgment methodology, and logistics regression methodology. Expert judgment type model, I think the banks may have been using this model for the assessment of the corporate credit. They use the data of the historical payment, qualitative, and also the macro business environment, also financial statements. So expert subject selection of the variables there, very not difficult to introduce, but it doesn't reflect the characteristics of the mother population of the scored samples. The next three approach or credit, the type of the scoring model is the using the logistic regression. So as I mentioned, that what kind of data to be used or what amount of the data to be used would define the character of the scoring model actually. Credit bureau type of the scoring model is widely used for assessment of the consumer credit risk and corporate risk by the credit bureaus. The data to be used is the mainly historical payment and qualitative data as well as the financial statement data, just as a sub-items. And also that the because of that, historical payment data is being used mainly. The characteristic of this scoring model is described as just a past behavior pattern or event-driven type. The next one is bank in-house type that is used by the banks for assessing the corporate risk using data is historical payment and financial statement with the many numbers of the variables. So this is just in-house data to be used for creating this scoring model. Then, although the variables, numbers of the variables could be a lot of or many, but amount of the data to be used is just limited to the in-house in the bank. So maybe characteristics would be described as a specific situation at the specific times. Lastly, I just want to mention about the CRD type of the scoring model. This is CRD Japan is using for the assessing the risk of the MSME corporates. Database is the financial statement, default, and non-financial statement data anonymized base. But the large numbers and wide range of the financial statement data is required. Just as an example, 26 to 59 items from the balance sheet and 9 to 26 items from the profit and loss statement, and creates 174 financial indexes as a candidate, and actual usage of the financial index were 20 to 30 for the explanatory variables. Images of the two types of the scoring model is described at those charts. Just, continue to the financial statements, CRD type of the scoring model. So this table indicates the financial indexes examples. So 20 to 30 financial indexes are used as explanatory variables, the scoring model. So this CRD type of the scoring model assesses the creditworthiness of the borrower by analyzing ongoing business performance of the borrowers from the financial statements, business performance of the stability, profitability, efficiency, and growth potential. So in summary, we come here, the significance of the CRD type of the scoring model is the model itself have a lot of data, the volume data is very large, as well as the variables of the scoring model. Many numbers of the variables are used. So because that those large number of the variables as well as large amount of the data is being used for the this CRD type of the scoring model. So the model itself become more accurate and more stable. And we try to map the which countries, which type of the scoring model is being used for the which kind of the borrowers. Usually that the US, Europe, and others, credit bureau type of the scoring model is being used, wide range of the borrowers. MSME, sole proprietorship, and consumers. Because credit bureau's presence is very large for those areas. And also that the large corporations, middle-sized corporations, bank in-house type of the scoring model is being used. In the case of Japan, because of the establishment of CRD type of the scoring model, the MSME and part of the sole proprietorship, nowadays, CRD type of the credit model is prevailing. Although that, consumers is also the part of the sole proprietorship, credit bureau type of the scoring model is being used, and also the large corporation and the middle-sized corporation, bank in-house type of the scoring model is being used. Actually, that the JICA is trying to, I think, seek whether that the other countries, especially Southeast Asian countries, they are interested in the same type of the approach in Japan, that is CRD type of the scoring model approach. And actually, that the Philippine government likes to establish same kinds of the credit database as well as the scoring model. And this project has started 3 years ago, and now at the stage of the giving the scoring to the member banks in Philippines. So it is still under construction, but actual output is coming very soon, the end of this April. Finally, we want to say it's just a transit to the Dr. Lan's presentation. We have here the financial statement-based scoring model, CRD type of the scoring model. At the same time, we have the scoring model based on the bank transaction data. We could say AI model or machine learning model. We just give you the snapshot how it differs in between these two. As far as this machine learning type of the approach, AI model is concerned, database or data is different. The bank account data or information from accounting application on the smartphone, those data are to be used. And this is rather informative but complex and time series of data. Although, traditional one is a financial statement. Because of that, frequency of the data is traditional model generally once a year. But the AI model or machine learning methodology is the frequency is quite high. The outcome is for the traditional model is a probability default within 1 to 3 years. Because it is based on the financial statement, but as for the machine learning methodology, it would be short term. Probability default within 3 months or 6 months, and so on. How it is to be used majorly or mainly is the traditional model is very good in establishing own internal rating system as well as the validating the own internal rating system. But as for the machine learning methodology, it would be very good for the evaluation of the MSME without financial statements. So that means that it could cover those corporates which do not prepare the financial statement. And at the same time, for the monitoring, high frequency and targeted monitoring. So the monitoring of the performance of borrower much more frequently. So I just want to end up my presentation here, and I want to hand the microphone to Dr. Lan for her presentation on the machine learning methodology.
Okay, thank you very much, Jiro, for the general discussion. Hello, everyone. I am Lan Nguyen of the CRD Credit Risk Database Association. We are based in Tokyo, Japan. Okay, so before diving into the discussion of the transaction data that Jiro mentioned and the credit risk modeling, I would like to briefly go through the benefits, some applications of machine learning, and introduce to you some of the most commonly used machine learning algorithms. And towards the end of the presentation, we will discuss how banks could quickly test if their transaction data is useful in predicting your clients' creditworthy needs. So I hope you will stay with us until the end of the presentation. So we have picked up here 4 reasons why machine learning is becoming popular in the financial sector. First of all, it is providing us with more accurate risk assessment because it can analyze a vast amount of data and identify patterns that are difficult for humans or traditional models to detect. So this helps bank to make more accurate lending decision at the credit underwriting stage to avoid bad loans. It also is providing us with a monitoring and alert system, which I will discuss a little bit in more detail later on. It also bring us the enhanced customer experience through faster loans approvals, because it is eliminating the time-consuming manual processes. And furthermore, it can tailor the service due to the insights into customers' behavior and preference, giving them a more personalized experience. Machine learning also gives us more improved fraud detection mechanism. So it can analyze large amount of data and detect patterns that can indicate potential fraudulent activities. Okay, so let me go on to demonstrate our point that using more advanced algorithms, machine learning can help us to analyze data with very difficult data patterns. For example, here we have 3 input data sets. The first one, and then we have 2 classes of data, the red dots and the blue dots. We have 3 kind of input data. The first one is like a moon, a crystal moon overlapping on another. The second one is the blue dots are somehow in the middle, and the red dots are covering the blue dots. And here we have a more straightforward data set, which the blue is on the left-hand side and the red is on the right-hand side. For a simple linear model, which is a traditional kind of model, it is doing a fairly good job to discriminate the blue dots from the red ones. For the first data set and as well as for the third data set. However, for the middle one, it seems not to be doing a very good job. But if we use machine learning, for example, this is a random forest algorithm, you will be able to separate pretty well the first and the third data set, as well as the second one. You see the decision boundary is blue in the middle, and the red decision boundaries are, it's doing a good job separating the 2 classes. Okay, so next, I would like to also mention the point that machine learning can tackle a vast amount of data. So let's look at the transaction data. For large regional banks in Japan, they often have about more than 10 million deposit accounts. So which bring us to about 1.1 million transactions per year. And it meaning that every hour you will have more than 12,500 transactions. That is a lot of data. And just for your information, just to be able to run a million of data point using the traditional logistic model, it will take a lot, the normal processor a few days to finish running. Of course, it depends on how complicated your codes are, but it's already taking a lot of time. And with machine learning, such as the random forest, it can work parallelly, allowing for the distributed processing across multiple processors, so that it will reduce significantly the time to process and train model. And then we also mentioned the advantage of of machine learning in loan monitoring, right? So at the loan monitoring stage, the automated alert system can be designed to notify the bank officials on a periodic basis, or it can, depending on the urgency of the matter. For example, in this graph, you will see that this borrower's account, the deposit balance is being overdrawn. That's why there is a very sudden drop in the transaction account balance, indicating a potential financial distress. And if the bank would like to be alerted in such when such event happens, it can ask the machine learning models to alert the bank officials when necessary. Okay, so I have plotted here some of the commonly used traditional and machine learning algorithm. So there's two dimensions of this. This is in terms of interpretability, and this is in terms of number of features. So we are plotting from easy to interpret to difficult to interpret. And the number of features are from only a few features to a large number of features. Features meaning how many variables you are going to include in your model. So toward the left-hand side are traditional models such as the OLS, logistic regression model, and moving toward the right-hand side here are more complicated models in machine learning, such as the decision tree, random forest, XGBoost, and towards the very far side in the right corner here are deep learning and neural network algorithms, which are often used for tasks such as autonomous driving, image and video analysis, which are very intricate algorithms, and they are often called black box models. Maybe let me walk you through a little bit about logistic models, because it is the most commonly used model in traditional credit risk scoring. And I think probably many of you are very familiar with this model. Okay, and we have this example here. The black dots are representing our data, each company in our data set. And we are plotting the actual default versus the debt ratios from low to high. So the red line here is our logistic regression model, while our the blue line here is the linear regression model. So you can see that the company with the lower debt ratio, which are those here, are often associated with non-default, and those with high debt ratios, which are here, are often associated with default. So to capture this type of correlation between default and debt ratios, the linear regression, which is just one line up to the upright, is not efficient enough to capture this type of data distribution. So The logistic regression, on the other hand, are with this curve, it is better at capturing the data pattern. So that is why logistic regression is often used in traditional credit risk rating models. So as I listed here, we have some applications, as I mentioned, in credit risk and in predicting loan default probability. And the most the best thing about logistics is it's simple and interpretable, and it can handle large data sets with a limited number of features. However, in order to produce reliable and stable estimates, it is required for logistics models to have a fairly large sample size in order to produce consistent estimates. Okay, so in machine learning, one commonly used and fairly easy to apply algorithm is the decision tree. I just show you quickly. I think most of us are familiar with decision tree. This is a tree-like structure. It has a tree-like structure, and each node in this tree here represents a decision or a feature, and each branch represents the possible outcomes. So, for example, we have the decision tree with two features here. The first one is the deposit balance, and the second one is the declining in deposits or sales. So in this model, the first thing that the model will check is the deposit account balance, whether it's large or small. It will come to the next node. If it's large, it's will be predicted maybe not default, and if it's small, it come to the next node. So if deposit balance here is small, the tree will move on to the next. The declining in deposit of sales is small. It will be moving on to the next prediction that it's not non-default. And if it's large, it will be going next to predict that this borrower has a probability of default. So again here, depending on the borrower's input data, the model will predict if the borrower has a tendency to default or not. Decision tree is commonly used in initial exploration of data or feature selection. It is very interpretable and easy to understand. However, it has the tendencies to overfit, and it's quite sensitive to noise in the data and maybe not be able to generalize well to new data. So that's why we would not oftenly use decision tree as our main model, but rather to opt for random forest, which is a more complicated version of decision trees. So random forest is essentially an ensembling method that combines multiple decision trees. I draw 3 trees here, but obviously it can be 100 trees or 300 trees combined all together, and to produce a more accurate and robust prediction outcome. So each tree in the random forest is trained on a randomly selected subset of data and a randomly selected subset of features or variables, which it means that it will be introducing diversity among the trees. And this kind of diversity will help to reduce the risk of overfitting to a certain set of data. And the combined prediction here, the average of all prediction will be generalized and less prone to outliers or overfitting in the data. Okay, so as already mentioned, random forest is robust against overfitting, and it can handle large data, as well as it will provide feature importance ranking. About feature importance, we will be able to discuss this later in the presentation. However, there's some cons to random forest, that it is not as easy to interpret as a single decision tree. And then due to its, if we introduce many trees and many training, it requires more computing time to compare to decision trees. And it may not perform very well on imbalanced data sets. Imbalanced data sets meaning that if you have a lot of ones instead of zeros, maybe you have 101 zeros and only a few ones in your data set, it might not perform that well. Okay, so let's revisit the example we see before. And logistic regression performed quite well for the first and the third data set, not very well for the second one, but random forest were able to classify did the task pretty well, clearly separating the two data sets. Okay, so finally about XGBoost. Actually, we want to also introduce you to XGBoost because it's also a more sophisticated algorithm combining the trees, but it just having a little bit different from a random forest. So again, XGBoost is also an ensembling algorithm, and it's also the same with a random forest in the sense that it will collect a lot of trees. However, the technique is a little bit different in which that each tree, the second one is the improved version of the previous one in the way that it will minimize the residual errors of the previous tree and gradually boosting the overall performance. In this way, the second one is better than the first one, the third one is better than the second one, and so far ongoing, it will be the last tree that has the best overall performance, most improved or boosted predictions. So XGBoost is also very well suited for credit scoring, and sometimes it is used in fraud detection as well. It can handle large data, high dimensional data, and also provide feature importance. However, it can be computationally expensive. It will take a long time to process and requires careful tuning of the parameters. So I just want to show here that both Random Forest and XGBoost is doing a good job of classifying the tricky data set here in the middle. So both of them are doing quite a very good job. On data exploration, data exploration is actually the first step in the model building process. In our building process, we have data preparation, including exploration, variable selection or feature selection, model building, and model validation. So in this part of the seminar, we will be looking into what kind of data is available out there for modeling. Now, most questions we get from central bankers and commercial bankers that what kind of data that we can use to analyze our MSMEs clients? What are the alternative options that we have besides the traditional financial statements and, of course, collateral? Okay. Besides transaction data that we will be talking into more details, let me just mention some other available alternative data that could be useful in the evaluating creditworthiness. First of all is commercial data, and then GPS data, review data on Google or Yelp, social media data, utility and rental payments. So before going into each of them, I would like to emphasize that the data has to be proven to have direct significance correlation with the repayment ability or the creditworthiness or default in order to be able to include it into our credit risk modeling. It must have an intuitive background, a backed statistical correlation in order to be included in the model. So I just introduced some of the signs or to good prepayment behavior, such as if you spend a good time studying or exploring the purchase before you actually made the purchase on e-commerce websites, it seems to be good signs of good repayment behavior. This is from certain studies. On GPS data that if you have a very regular schedule without not much anomalies in your schedule, it also can be linked to good repayment behavior. And of course, reviews data on Google's reviews. It's very important, fairly important for restaurants, for example, or for small businesses in service sector, that it could help linked to repayment behavior, to sales first, and then to repayment behavior. Social media data, there's studies that show that if you have a frequent contact to a certain groups of people, maybe your clients or your business partners, it might be linked to a good marketing strategy, and it's could be a positive added to the repayment behavior. And of course, finally, a good track of record of utility payments, it also indicate your repayment ability. On transaction data, as maybe Jiro has mentioned earlier, it refers to all of the cash inflows and outflows to and from a certain bank accounts. So any MSMEs who owns a bank account should have this data available. And the data we refer to clarify, is not on paper-based banking statement slips that the account's owner keep, but it's already digitalized systematic data that is archived in the bank system. And this data is available in abundance, and it's accurate, and it's very difficult to manipulate such this kind of data, different to financial statements. And then we listed here a few examples of inflows of transaction data. And you can see that inflows including sales revenue, rental income, investment income, interest income, all kind of incomes to the business. And here are the outflows examples. So there are salary payments, payments to suppliers, to our renters, of course, utility payments, and payments for various services and rentals, premiums, for example. So in Japan, we have one transaction coding system. It's called the Zengin system. And it will have a unified code for all kind of transactions. In the US, I think up until our study, the Federal Fund Service system, and in Taiwan, maybe the FISC system. It could, they are the commonly transaction coding system to capture the payments, receipts, transfer, direct debits and credit card transactions, to classify the transactions based on purposes. However, these are all domestically used by financial institutions in each country. So, okay, and then in our case, in the CRD Japan case, all of these, the data that I showed earlier, many of the data, it is classified by transaction code, and regrouping those transactions into transaction purpose groups, based on our experience and on our financial expertise. to lessen these inflows and outflows to under 10 categories for inflows and outflows, and also the balance of the account. The next step of the model building process is model selection. This is the third step of our model building process. So we would like to revisit the earlier chart that we shown before. We have remember that we have discussed the far right hand corner. Those are the black boxes model. For example, in autonomous driving, they use black box models to identify if that is the human walking or not. So in that case, it is important that the algorithm was able to recognize the human walking, but it's not that critical for us to know how the algorithms come up with such decision. So it is fine for using a black box in those fields. However, credit risk management, it is not recommended to use black box, but we would use a gray box instead. To avoid black box in credit risk management, and while using gray box, such as random forest or boosting, or other boosting algorithms like XGBoost or other boost is okay in credit risk management. For obvious reasons, to avoid black box, because it's lack of interpretability and explainability, we have to explain our lending decisions to our customers as well as to our regulators. We have to understand the reasons behind a borrower's credit scoring or credit rating. So that is for obvious reason. And for regulatory concern, banking sector like central banks often requires the validation of the internal scoring model. I think yearly. But if the bank cannot understand the logic and it's too sophisticated to validate, then probably there's some regulatory concerns there. On the other hand, it is good to use gray box because, as explained, they are more powerful in terms of picking up complicated data patterns, more robust than the traditional white box. Like not to mention the computing efficiency when dealing with the vast amount of data. Furthermore, they are not completely black box because they offer some degree of interpretability or transparency and can provide insights into which variables are most important for making predictions. This is referring to the feature importance that I'll show you this picture of the feature importance. So each bar in this feature importance graph show you the how much each feature contribute to the model's prediction. So the higher the bar, the more important the feature is for the model. So this graph would be able to graph for any models and any random forest models or XGBoost model to help us to easily identify the most important features and can help us to guide through feature selections and our engineering efforts. Model selection, we also need to avoid models that are underfitting or overfitting. So for underfitting models, here in this example, we have this true function, which is orange, and the model, which is this line is blue line here, and our sample data is in here. So this underfitting model, the model is too simple and lacks capacity to capture the complexity of the data. On the other hand, on this side, we have an overfitting model. Here, the true model is the orange, but the model that we developed is in blue. It is capturing all of the points, all of the data are in this data set. And obviously, this function is too complicated. It won't work if new data is introduced or if it meets a completely new data set. So there are a few ways to mitigate this overfitting problem. One of them is to use cross-validation to evaluate the model performance on multiple folds of data. So essentially, cross-validation is that you divide the data set into multiple folds. And then you use, for example, in here, we divide this data set into 5 folds. And you will use the fold number 1 for testing while training the data on fold 2, 3, and 4, and 5. You will be doing this for 5 times. The second time it will be, you will keep the fold 2 for testing and use fold 1, 3, 4, 5 for training. So on and so forth to be able to find the parameters or the coefficient of the model. So the basic idea behind the cross-validation is to use all of the available data for both training and testing to obtain a reliable estimate for the model's performance. This helps to, of course, to mitigate the problem of overfitting, potential bias, and help the model to be able to adopt if there is a new data set introduced. Okay, so model assessment, it means that the model, we like to know if the model is interpretable or not, how accurate it is in predicting, very important, right? And then if it's stable across time, stability, and with all of this, are we going to be able to maintain it afterwards? On interpretability, if we can interpret the models or not, we need to be able to explain our variables, how it's actually related to default. So, okay, on the left-hand side here, we have the graph that we have plotted the deposit balance against the default rate. So the relationship is negative, meaning that the larger the deposit balance, the less likely the company will default. This is very easy to comprehend and easy to explain. And on the right-hand side graph here, you can see that this is the time series of the deposit balance. So if with time, if deposit balance have a declining trend, this decreasing trend, it signals a higher chance of default. So easy to interpret. Interpretability is important. Okay, and then on the how accurate the model can, how accurately the model can predict, there are several number of metrics to check the model accuracy. But we only introduce you to the so-called receiver operating characteristics curve. This curve is plotted using the true positive rate and the false positive rate. While the true positive rate is the fraction that the model was able to correctly identify default. So the model predict default and the actual observation is also default. So that is called the true positive rate. And the false positive rate calculates the fraction of the model that incorrectly identify non-default as default. So the model predict default, but the actual observation is non-default, and this is the false positive rate. So basing on these two rates, we will be able to draw this graph. The model here, this orange line is our model, and the true positive rate and the positive rate help us to draw this line. The area under this orange line is called the area under the curve, AUC. This is commonly used for model accuracy matrix. So if you are going to compare between models, or you talk to your analyst friend and ask for their model, you can ask what's your model AUC, and then it will be a commonly used across the industry. So from AUC, you will be able to calculate the accuracy ratio, which is another matrix that is more commonly used in among the Japanese bank. Okay, so the higher the AUC to 1, the better the model is, essentially. Okay, and then this this dashed line in the middle is just a random model. With AUC equals 0 and AR equals, AUC equals 0.5 and AR equals 0. All right. Okay. And then stability, we also mentioned stability being whether the model would be able to perform well across time. So we will be using out of sample data. For example, in each period, like you will make the model or construct the model on period 1, but then period 2, 3, 4, 5, 6, you continue to collect data and use those data for out of sample validation, and we'll be able to calculate the accuracy ratio or the AUC for each of the subsequent period. So for model A, you can see that there's a stable pattern. But for model B, there's a declining pattern. Maybe it means that model B was an overfitting model at the beginning, and it cannot, when it meets new data, it fails to actually perform. Okay, so we are concerned if the model can works across time. Okay, and final on proof of concept. Thank you very much for staying with us until the proof of concept. So proof of concept is very easy to understand. It's just easy to verify or testing if the model of the scoring model on the bank's already available data. It is often done before prior to the model actual model deployment, and this proof of concept helps banks to know if they have the necessary data to employ the model and what is the expected level of accuracy. Remember, we talked about accuracy just now. What is the expected level of accuracy will be. Okay, so in Japan, we have several transactions models. Our organization, the CRD Association, we also have our transaction model, and some individual banks, they also construct their own transaction model. And our transaction model is currently being used by Resona Bank, one of the 4 mega banks in Japan. And it has introduced a credit line for MSMEs that is using this transaction model as at loan screening. So the interest rate is about 3.3% to 9%, only slightly higher than the rates for traditional loans. And the requirements for loan screening is only that if the borrowers would have the transactions data or the account at the bank for a certain period. It doesn't require collaterals, and it doesn't require guarantees or any submission of financial statements. So purely based on transactions model. Just a quick introduce of the accuracy of our CRD Association model. As mentioned earlier, our AUC, area under the curve, for our models is 0.85, and accuracy ratio of 0.7. It is higher than the industry level of transaction model. By the way, we use random forest and XGBoost, as our model algorithms, and of course transaction data with more than 6,000 features. Proof of concept is straightforward. The bank, the process is straightforward. The bank would extract and arrange data into a pre-provided template, and that will be used as the inputs for our model algorithms. And then we will calculate and give you a report of accuracy ratio, or how well the model performed on your data. And then, if it's high, if it's successful, we may consider for deployment. Okay, here are some examples of the outputs of the POC. So overall performance of the entire data set. And if needed, we can generate the performance for each segment, such as each industry sector or each business sector. And then even we can try doing the credit score for the borrowers, if applicable. And then we can try to map our credit score to the bank's own internal rating score for comparison, as well as to identify accounts that needs special attention. And sometimes we do case study to pick up some borrowers for the better understanding of your data. If you're more interested in our transaction model, you can find the more description in our paper written with the ADBI on credit scoring and machine learning. And you can also find the proof of concept that we have done for the Hong Kong MA, Monetary Authority, for their white paper on alternative credit scoring. So you can find these two papers by keying the keywords that I'm showing on the screen. It's a very interesting paper, especially for the Hong Kong MA model. So kindly check it if you have time. Okay, so I know that's a lot to digest in one sitting, but I hope we were able to provide you with some important information that you needed. Okay, thank you very much. Please feel free to contact us anytime. Thank you.
Thank you, Dr. Lan Nguyen. We are now going to turn to the questions submitted from the audience. The first one is how to deal with non-binary category variables in logistic regression.
The binary category variables means explained variable type. So that takes 1 or 0, means default or non-default. So we can use the continuous variables or categorical variables, not binary variables.
Okay, the next one is, how are you able to get the social media data, given that the likes of Facebook has discouraged scraping or linking via APIs?
So I'm sorry, but we don't use the social media data. So the Dr. Lan just show you examples as alternative data.
Okay, the next one is, how could be causing an SG boost model to give different accuracy results with the same parameters on each run, even after cleaning and retraining the data sets multiple times?
We have, I think, the hyperparameters are trained each time, and you get the different accuracy matrix. Honestly, I need to see the data and run it for myself to be able to give a correct answer to this.
Okay, so probably, you can discuss this internally and get back to the person who raised the question. Is that okay? Okay, thank you. Let's move on to the next one. We got several questions on hand. For utility and the rental payments, how are you able to gather data? Do you have a data sharing agreement with these third-party utility companies?
Yes, you need to have a data sharing agreement with not only the utility companies, but for all of the data source that you wish to use. For example, of course, the utility company, as well as, for example, if we are going to use transaction data from the banks, we need to also have the sharing agreement with them. Some privacy issues might be concerned, whether or not they can share private data. It's especially strict in Japan if you want to share private information. I'm not sure where the question coming from, but privacy issues might be one to be taken care of before you have a data sharing agreement.
Thank you, Lan. The next one is, does your platform support mobile apps?
At the moment, we don't prepare the platform for the mobile apps. Yeah, in the future, if you want.
Okay.
Yeah.
Yeah, it's under development, right?
Mm-hmm.
Okay. How can a lender determine which machine learning algorithm is best to use for its alternative credit scoring model?
Okay, it depends on what type of data that you have. Normally, the algorithm that we shown you earlier, random forest, XGBoost, SVM, they are pretty good with dealing with data, various data. But if you have data such as like images, voices, then those might not be the correct one to use. Maybe some black box model. Those are the ones that can analyze like voices, images, better than the model that I showed before. It depends on which type of data that you have.
Okay, thank you. Next one. Is there a way to determine how effective an alternative credit scoring model will be at predicting default based on the quality of source of the data and the machine learning algorithm?
Actually, there are many metrics that measure the model performance. And to be honest, we'll try all types of models. We tried all types of model and train all of them. So, and then we compare the performance matrix. And the one that has the highest one, of course, is chosen. And of course, it has to be having an explainable, a very interpretable features included in the model. It will be chosen as the model of use. So I'm not sure of what kind of data that you have, but in practice, I think maybe some machine learning analysis in the audience will agree with me that we will have to try a lot of models.
Okay, thank you. Let's move on to the next one. Can we use the PCA-SVM hybrid model based on the nature of the data set?
SVM, I understand, but I never see it together with the PCA. PCA is such the principal component analysis. Mm-hmm.
Okay, so probably you can ask the audience to provide you with more information, right? You can further discuss it.
Yeah.
Okay, the next one.
Oh, sorry.
Sorry, then go ahead.
Used, but I have never seen it together with the PCA, and I would like to have more information on it.
And yes. Sometimes it's not easy to understand the variables means. So since it's for practical use, it doesn't fit well, I think.
Next one, what is the best type of model that you can recommend for a financial institution that has very limited data?
Very difficult question. Please. Yeah. Creating the data set is a very heavy task, but you can try the model building for many times and all kind of model, and then you validate the model accuracy. Then you choose pick one and easy to understand. Yeah.
How limited is it? A few hundreds, or if you have more than 10,000 or a few thousand already, you can try logistic first.
Okay, thank you. Next one. What's the industry acceptable benchmark for ROC/AUC and other model metrics?
0.8.
Our ROC 0.8. Industry level, yeah. Some data with some small data set cannot reach that industry level.
Okay, the next one. Where can we find industry standards method to determine accuracy of models?
Well, you have to probably talk to a lot of banks because in our organization we have a lot of members banks, and we would have information and get the information of what's their own internal ratings model accuracy. So we kind of know what's the industry standard, but obviously in Japan the standards are much higher than in other Southeast Asia that we have worked with. So it depends on which country you're in and what is your expectation. So, with small data and limited features, you cannot expect too much.
Okay, thank you. Next one, are there external/alternative data that you are including in the POC, proof of concept, or just work on the bank's internal data?
At the moment, we are focusing on using transactional data only, as I presented in my presentation. For other sources of data, as I also mentioned, has to have a very clear correlation with default, very clear backed theory behind the reason why we should include those into our established model. So we are not really looking into other types of alternative data to include in our POC at the moment.
And the bank can use a model only their internal data. So.
Okay, thank you. The next one is AR for bank's entire data set. This says in your material, what does AR mean?
AR means accuracy ratio. It can be directly translated from AUC. AUC is area under the curve, minus 0.5 multiplied by 2.
How much historical data do you need to train your model?
For the model, at the minimum, we would be needing approximately a year, 1 year data, so that 6 months would be used for the model construction, and then the 6 months would be using for the validation. But that's the minimum data points. But then if we have the more data, for example, 24 years, then it will improve the model efficiency. And it's actually proved to have the higher efficiency for the Japanese case. So we can start from the minimum data point, but then we also need to look into using more number of the data.
And when we build a model from the scratch, how many terms, how many years?
Okay, if we build the model from the very scratch, then approximately 60 months. That's nearly 5 years of data we would be needing.
Okay, that's answer the last one. We have too many, but for those unanswered question, we will pass them to the CRD Association, and probably they will reach you separately and to answer your question, because most of the questions are quite technical. Okay, so the last question is for Lan. You mentioned that the black model is not recommended because of being too complex and difficult to interpret. On the other hand, the data is continuously increasing its volume and the element of variability. Do you think we will be going to use the black box model in the near future?
Actually, at some point within our organization, we were also looked into using neural network to analyze the image of some of the financial ratios. You can see that ratios coming up and down in the Excel sheet. We can actually make a colored table out of those financials indicators. If it's going up, we can color it as green, or going down, we can color it as red. And then we were also trying to use neural networks, which is a visual analysis tool to check these kind of images. But honestly, it doesn't perform very well compared to our gray boxes model. So, well, in the future, I think AI will take over us. So maybe we can still use the black box in the future, but it's not, as long as you cannot interpret what the decision is, I cannot explain it to your customers. Probably not recommended for the moment.
This brings us to the end of the webinar. I hope that you have enjoyed and the content has been relevant, insightful, and ultimately valuable for you.
Thank you so much.
Thank you.
Thank you.
See you. Bye-bye.